Had quite a few clients come to me recently that have talked to other lenders already about refinancing, and they're trying to compare one mortgage versus another mortgage. And it's really not just black and white. You can't just look at the interest rate. You can't just look at the APR. You can't just look at the closing costs. So in today's video lesson, what I wanted to do was show you what you should be looking at and how you can accurately and properly compare different refinance offers when you're shopping around. Hey, it's Robert Weinberg, and on this channel we empower people to take control of their futures through expert mortgage and financial strategies. In today's lesson, we're going to be talking about how to compare different refinance offers, as this is going to be applicable if you're shopping around and you're talking to different lenders. Now, I'm somebody who really thinks that you shouldn't need to shop around. If you have a trusted mortgage advisor, somebody who's been referred to you or that you find that has excellent reviews, a great reputation, and has a lot of experience, then as long as you trust them and they're giving you something that you feel is a fair deal, I really suggest that you stick with that. This is more for people that don't have a trusted local mortgage advisor and you're needing to talk to different banks or lending companies to find out where you're getting the best deal, and that's where this video and this lesson is really going to apply. So the first thing that I want you to understand is it's very important that you compare apples to apples when you're looking at two different refinance offers. You can't compare a conventional mortgage to an FHA mortgage. You can't compare a rate and term refinance where you're just lowering your rate to a cash out refinance where maybe you're paying off debt, consolidating things, or taking cash out for home improvements. At that point, you're comparing apples to oranges. You're just going to confuse yourself and you're going to end up making the wrong decision. So make sure that you are side by side comparing two loans that are going to accomplish the same goals for you. That's what I mean by apples to apples. Something really important that you read up front is the fine print. So because of the refinance frenzy that's been going on, you may have seen ads online, on TV, billboards, or gotten solicitations in the mail for refinancing your home. But all of these have fine print, and it's really important. The devil's in the details. You need to read the fine print, because every single time that you read the fine print, you'll see that the offer that you're getting, the solicitation that you're getting, probably doesn't even apply to you. And what I'm talking about is typically those solicitations are going to have points included. So they're going to show you this super low rate, but then you read the fine print and oh, it's got 2 or 3 points. That's real money that you're going to have to pay to buy the rate down. They don't put that up front, they put that in the fine print. The next thing is LTV, or loan to value. So a lot of these solicitations that come in with the low rate, it'll say, oh, this is for somebody that has 50% equity in their home or 40% equity in their home. Well, most people that are looking to refinance don't have that much equity. So again, the offer you're looking at, you're getting so excited about, probably doesn't even apply to you. Credit score. A lot of times you have to have a 780 or 760 plus credit score to get the offer that they put on that solicitation or proposal, and you may only have a 680 credit score or 700 credit score. These are all things that are going to come up when you call that company to apply, and then they say, oh, I'm sorry, Mr. Jones, we can't give you the 2.3% that you got on the mailer or that you got in the email. We're going to give you now a 3% because that's what you qualify for. Know this information up front. It's going to make you better armed as a homeowner and as a consumer to know the games that these companies play. Loan amount is another really important thing. They may show you a mortgage rate for a $250,000 loan amount, but you only need $100,000, or you need a lot more. Maybe you need a jumbo loan for $800,000 or $1 million. Again, these offers are just solicitations. They're designed for you to call them or reach out to them online so that they can then bait you, get your information, get you engaged in the process, and that's when it all changes. I did another video about the different factors that go into the interest rate, and that's really what I'm getting at here, is that there's so many different factors that go into an interest rate that there's not just a blanket rate. You can't just say, what's your rate today? Not everybody gets the same rate. All of these factors, along with many others, go into the actual rate that you're qualified for. So reading the fine print and knowing what rate you're looking at and what criteria you have to meet to get that rate will make you better armed and more knowledgeable as a consumer. Again, know the games that these companies are playing. Now, another thing a lot of people like to do is look at APR. So you have one loan that's got a 2.9% APR and another one that's got a 3.1% APR, and you say, oh, well, the 2.9 is better than the 3.1. But that's incorrect. APR, there's a lot of flaws with the APR calculation, but it can be manipulated. There's ways that lenders can move fees around and change things so that the APR can be manipulated by them. It can appear to be a lot lower than it actually is. But the most important thing that you realize as a homeowner about APR is it's really not even a great comparison tool whatsoever, even if you understand it, because an APR is based off of you keeping the loan for the entire term. So if you're looking at a 30-year fixed mortgage, the APR is based off you keeping that mortgage for 30 years. But what if you only keep it for 3 years? What if you only keep it for 5 years? The actual APR can only be calculated once you pay that loan off by selling or refinancing. So looking at an APR as the godsend to tell you which loan is better is absolutely incorrect for all these factors that I've mentioned. Where you should be looking, we've talked about what you shouldn't be looking at. Where should you be looking? So the best place and where I guide all my clients to look at if they're comparing offers is the loan estimate. You know, I did a video a week or two ago with a detailed breakdown of the loan estimate. This is a standardized federal document that has all the different fees laid out. It has all the information about the loan program, the interest rate, the payment breakdown, all that. And this is where you can legitimately compare two offers side by side, is you get a loan estimate from both lenders. They will, by law, issue you a loan estimate within 3 business days of your application. They're supposed to, or they're breaking the law if they don't. But by them giving you that, you can then look side by side at the loan. What's the loan type? Are they the same? What's the actual interest rate? Is it a fixed rate or variable? What's the payment? How much are they using for escrow? One big trick I've seen a lot of lenders use, especially ones that are doing business nationwide, is that they'll put a really low number in for your estimated property tax or your home insurance, thinking that you won't catch it. So you're looking at it going, wow, my payment is $100 less with this lender than it is with the other. But when you compare the details, you'll see that that lender miscalculated your property tax or your insurance. That's why it's so important to work with a local experienced advisor so that they know what the property taxes are. They can go on the website for your city or town, pull the information, get estimates on insurances and whatnot. Make sure that you are actually getting the right loan for your needs, and that applies to you. Like I said about the escrow, make sure that it's accurate. Prepaid items. A lot of lenders will put in no escrow, or they'll put like a really small amount in the escrow account, and then they'll change it on you all the way at the end. Well, that's not a good way to go, because it will inflate the closing costs if they put too much in escrow. So that's why they try to put a lower amount in the escrow account, because they feel like, oh, well, then it'll look like your closing costs are lower. But no matter who you refinance with, doesn't matter what mortgage company you use, we all have to put the same amount in escrow. So just because they put a low amount up front to entice you doesn't mean that that's the correct amount at the end. So escrows are a huge place, and the prepaid items that can be manipulated by your lender to make it look like the loan is costing less than it actually is. And another important factor to look at here on the loan estimate is the PMI, the mortgage insurance that you may have. There are different programs, affordable loan programs like Home Ready and Home Possible, that allow you to get a discount on mortgage insurance, PMI premiums. Well, if you have one lender that knows that, that's experienced, and one that doesn't, then it may not be looking the same. One may show $80 in PMI, another may show $30 in PMI. You don't know, you just look at the 30 and think that that's better, and I'm not saying that it's not better, but you need to know why that it's better. And it's because they used a different PMI premium amount based on maybe you qualifying for an affordable housing loan. So that's another huge piece there. And then last but not least is the cash to close. A really sneaky thing that I've seen quite a few lenders do lately is that they will show you this low loan amount, low payment, and it all looks good. But then you get down to the cash to close, which is the last line on the first page of the loan estimate. And that cash to close will show that you have to bring money to closing. $2,000, $3,000. I even saw one last week that the borrower had to bring $5,000 to closing. They weren't told that. They were just rushed through the process and told this is the loan. They were not explained that they were going to have to bring $5,000 to closing because the lender didn't put enough of the loan amount in order to actually keep all of their escrows, all of their closing costs into the new loan. So these are the really important factors and the sneaky things that a lot of lenders are doing that make it difficult to compare refinance offers. You know, they want to confuse you as a homeowner because they feel like by confusing you, you'll just sign and move forward. But it's important that you have a mortgage advisor, as I said, that's experienced, that can really break this stuff down for you and give you the best loan for your needs without playing these games, without playing these tricks. So if this is your first time watching us, go ahead, hit subscribe. Also click the bell so you get notified on all of our future content. If this has been of value, please reach out to me. If I can help you, I'm licensed in Connecticut, Massachusetts, and Florida. You can reach out to me via call, text, or private message. And of course, you can follow me throughout social media. Really hope this helps, and we'll talk to you soon.